How the rich avoid paying taxes. Many people hate taxes, and it's unfair when you earn little money, but still have to pay a lot of taxes. While some rich people openly brag about not paying taxes, some wealthy individuals like Robert Kiyosaki and Donald Trump have publicly talked about how they avoid taxes. You might wonder how they can openly talk about paying less tax, even less than you, or paying nothing at all. When we all know that not paying taxes is illegal, why doesn't the government do anything to make these rich pay more taxes? And perhaps you've heard about individuals and companies getting caught for tax evasion. So what is the difference between those people and the wealthy who openly claim they don't pay taxes? The truth is the rich have very clever ways to pay less tax, or even no tax at all. There are two main ways to avoid taxes: tax evasion and tax avoidance. Part 1, tax evasion, or illegal tax dodging, is when someone breaks the law by not paying taxes they owe. This means lying to the government about how much they earn, or hiding money so the government won't know. This is illegal and can get people into serious trouble. Let's break down how tax evasion works through a few examples. The first method is underreporting income. This means they tell the government that they earned less money than they actually did. Let's say Bob wants to buy a house from John for $700,000. If the tax rate is 10%, they would need to pay $70,000 in taxes. But to save money, Bob and John agree to lie about the price. Bob still pays John $700,000. But they tell the government the house was only sold for $500,000. This way, they only have to pay $50,000 in taxes instead of $70,000, saving $20,000. This is illegal because they are lying about the real selling price to avoid paying the full tax amount. The second method is hiding assets. This means people hide money in places where the government cannot easily trace it. For example, Switzerland used to be famous as a tax haven. A tax haven is a country with very low taxes and strict privacy law, which makes people like hiding money there. Normally, banks must report information about their account holders to the government, so taxes can be calculated accurately. But Swiss banks were known for their privacy and for not sharing account information with tax authorities from other countries. So if a wealthy person deposited money in a Swiss bank account, their home government would have no idea. Here's how it works. Let's say Tom, an American who earns a lot of money, but doesn't want to pay high taxes on it. So Tom opens a bank account in Switzerland. Because Swiss banks kept this information secret, Tom didn't report this money to the U.S. tax authorities. By hiding his assets this way, he avoided paying taxes on it. Tom managed to avoid paying taxes on that income. This is illegal because Tom is lying about where his money is kept and not reporting it to the tax authorities. However, this changed when many countries began pressuring Switzerland to share information about account holders with their home country tax agencies. So now, if a wealthy American tries to hide money in a Swiss bank, the bank will report it to the IRS, and he will likely be arrested immediately. The third tactic is false deductions. This means a person or business lies about their expenses to make them appear higher than they really are, reducing taxable income and paying less tax. For example, imagine Sarah owns a pizza restaurant and earns $100,000 a year. If you run a business, the government allows you to reduce your tax burden to encourage business growth by letting you deduct operating expenses before taxes. So if Sarah earns $100,000, instead of being taxed directly 20% of $100,000, which is $20,000, the government allows her to spend part of that money on business expenses first. If Sarah renovates her restaurant for $30,000, she will only pay 20% on the remaining $70,000, which is $14,000. But Sarah wants to pay even less tax and keep more money. So she spends only $3,000 to renovate the restaurant, but falsely claims she spent $30,000. This reduces her taxable income to $70,000. Now she only has to pay 20% of $70,000, which is $14,000, plus the actual renovation cost of $3,000, bringing her total expenses to $17,000. By inflating her expenses, she reduces her taxable income, pays less tax, and keeps $83,000. If she had been honest and spent the full $30,000 on renovations, her total expenses would have been $44,000, and she would only keep $56,000. The problem is that Sarah was supposed to spend $30,000 to renovate her restaurant, only spent $3,000 and pocketed the remaining $27,000, but lied to the tax agency saying she had used the full $30,000 to reduce her taxable income and avoid the taxes owed. In short, tax evasion is illegal, a crime, and can get you into serious trouble. However, there is a legal way to pay less tax, called tax avoidance. Part 2, tax avoidance. Tax avoidance is the use of legal, smart strategies to reduce the amount of tax you owe. It's like finding small loopholes in the tax code, or taking advantage of deductions and tax benefits allowed by law. While tax evasion can get you fined or put in jail, tax avoidance, this is considered a smart financial strategy. So instead of breaking the law, you simply use the rules to keep more of your money. Let's break down how tax avoidance actually works through a few examples. The first tactic is using controlled foreign companies, also known as CFCs, or controlled foreign corporations. This is a company set up overseas, in a place with very low or zero taxes, often known as a tax haven. By doing this, people can shift their profits into these foreign companies to avoid paying high taxes. A real-world example is Apple. That's right, the iPhone maker, and many other electronic products, you know. Apple avoided a massive amount of taxes, around $44 billion in just 3 years, from 2009 to 2020, by setting up shell companies. One of the first shell companies was called Apple Operations International. This company had no employees, but brought huge tax benefits to Apple. So how did this shell company work? Ireland's tax laws determine tax residency based on where a company is managed and controlled. But U.S. tax law determines based on where the company is incorporated. Apple exploited this difference by setting up a company in Ireland. The U.S. couldn't tax it because it was incorporated abroad, and Ireland couldn't tax it either, because Apple placed its management in the U.S., essentially avoiding taxes in both countries. The second tactic is transfer pricing. Transfer pricing happens when a company moves money between across different countries. The company sets its own prices for goods or services, so profits appear in low tax reducing countries, their overall global tax bill. For example, imagine John owns a company called Wig-Wichu Corporation in the U.S. His company launches a new shoe and earns $1 million. Suppose the U.S. corporate tax rate is 35%. Normally, he would pay $350 in taxes and keep $650 million. But instead of paying that 35% tax, John decides to use a tax haven, like the Cayman Islands, where corporate tax is 0%. So John creates a subsidiary there, called Wig-Wichu Cayman Island Corporation, and transfers all patents and intellectual property rights to it. When the U.S. company Quickie Shoes sells a new shoe model and earns $1 million, they claim they must pay $800,000 to the Cayman for using Quickie's patents and IP. So only $200,000 count as taxable income at in the 35%. US. They only owe $70,000 in U.S. taxes and pay zero taxes in Cayman, keeping $930,000 in after-tax. This helps John save $280,000 in taxes. The corporation to this subsidiary. When the American shoe company Quickie sells a new shoe model and earns $1 million, they claim they need to pay $800,000 to their subsidiary in the Cayman Islands for using the patents and intellectual property of the Quickie brand. This means in the U.S., only $200,000 is counted for. The 35% tax, the company only has to pay $70,000 in U.S. and no taxes in the Cayman Islands, keeping $930,000 in after-tax profit. This helps John save $280,000 in taxes. However, John cannot bring these $800,000 from the Cayman Islands back to the United States without paying taxes. So what will John do? John can reinvest the money overseas or wait for a new tax reform. For example, in the year 2020, the U.S. corporate tax rate changed from 35% down to 21%. If that happens again, John can bring the money back to the U.S. at a lower tax rate. If John decides to bring the $800,000 back at the new 21% rate, he will have to pay $168 in taxes, keeping $632,000. John will have $762,000 after compared to $650,000 if he had paid the original 35% tax. The third secret is using dividends, as I mentioned earlier. Warren Buffett, one of the most successful investors in the world, actually pays less tax than his own secretary. How does this happen? Because most of his income comes from dividends and long-term capital gains, not from wages. Dividends and long-term capital gains are taxed at a lower rate than regular income. For example, while a $100,000 salary may be taxed between 22% and 24%, $100,000 in qualified dividends and capital gains is only taxed around 15%. This tax advantage allows Buffett and other wealthy individuals to pay less tax on their investment income, because tax laws treat this type of income more favorably. In summary, tax evasion is illegally avoiding taxes by hiding money, while tax avoidance is using legal methods to reduce or even avoid tax bills. Although tax evasion is risky and illegal, tax avoidance can be a smart way to manage your finances within the law and bring benefits. However, It's also important to note that some strategies people think are tax avoidance are actually tax deferral. Tax deferral means you only delay paying taxes, but eventually still pay the same amount. For example, contributing to a 401k retirement account, using 1031 exchanges for real estate, or IRA retirement accounts, and other types. These strategies only help delay taxes to a later time, unlike tax avoidance, which aims to reduce the total tax owed. If you want me to make more videos explaining these topics, please like and subscribe. Thank you for watching. Goodbye.